Welcome to the special episode from Klarmans TV. Today I'm going to be talking about the main or key aspects of the 2017 budget that was recently announced in March.
As we start our negotiations to exit the European Union, this budget takes forward our plan to prepare Britain for a brighter future. It provides a strong and stable platform for those negotiations. It extends opportunity to all our young people. It delivers further investment in our public services, and it continues the task of getting Britain back to living within its means.
The annual budget affects almost every taxpayer in business. However, a lot of business owners and taxpayers are not fully privy to what the budget means and how it could affect them and their business. So in this particular video, I'm going to try and address as many of the major points of the budget for the coming 2017 tax year, um, ranging from self-employed to small company owners. This is the main area I'll be talking about. So let's start by what exactly is the budget. So for each financial year in the UK, which runs from the 1st of April to the 31st of March, the UK's HM Treasury announces the annual budget. The budget basically outlines how the Treasury and HM Revenue and Customs will collect revenue through the taxes. It also outlines how the Treasury aims to spend on the various public services, for example, transport, infrastructure, national health, public education, and so on forth. So this year's budget was for the 2017 tax year, which is the current tax year, was put in place by the current UK Chancellor, which is Philip Hammond. The Chancellor basically is the head of HM Treasury and more or less responsible for all economic and financial matters relating to the UK. So let's talk a little bit more about the current Chancellor of the UK, who is Philip Hammond. He took over from the previous Chancellor, Liam Fox, in July 2016, which is roughly the similar time Theresa May took over from James Cameron as Prime Minister. He has an extensive background in business. Before he entered politics, Philip Hammond has been involved in manufacturing, healthcare, and property development. He has also worked as a consultant for the World Bank, as an advisor for the government of Malawi. So some would say a wide-ranging background for a position as Chancellor. So the annual budget basically addresses a wide range of topics and areas, from tax, business issues, the economy, public borrowing and spending, pensions and savings, education, and national health. However, in this particular video, I will be focusing mostly on tax and the small to medium-sized sector. Okay, so let's start with personal tax, a tax that practically affects all taxpayers in the UK. Here's what the Chancellor had to say about personal tax in his budget.
So that people doing similar work for similar wages and enjoying similar state benefits pay similar levels of tax. As our economy responds to the challenges of globalisation, shifts in demographics and the emergence of new technologies, we've seen a dramatic increase in the number of people working as self-employed or through their own companies. Indeed, many of our most highly paid professionals work through limited liability partnerships and are treated as self-employed. There are many good reasons for choosing to be self-employed or working through a company. Indeed, Mr. Deputy Speaker, I have done both in my time. And I will always encourage and support the entrepreneurs and the innovators who are the lifeblood of our economy. People should have choices about how they work, but those choices should not be driven primarily by differences in tax treatment.
So the tax benefits and incentives of working as a self-employed compared to being employed are all well known. However, now NI contributions are the main source of revenue for the Treasury. And the self-employed were costing the UK Treasury millions a year by avoiding paying any national insurance they would have paid if they were being a self-employed. However, the Treasury now are quite keen on clamping down on this loophole altogether. especially more so that the self-employed are practically entitled to the same state and pension benefits that an employees are. So to close the gap on the national insurance or NIC contributions paid between employees and self-employed, the UK's Treasury is starting by focusing on the Class 4 national insurance contributions. These are paid by self-employed workers currently at 9% on all taxable self-employed profits up and above £8,060. But now this is set to increase to 10% from April 2018 and then a further 11% from April 2019. So this gradual increase is set to raise an additional £145 million in this year alone for the UK's Treasury. The most affected by this will be the self-employed contractors, doctors, lawyers, builders, plumbers, etc., who always historically have conducted their work as self-employed. They will see their overall NI liability increase by the way of their self-assessment tax returns each year. The only other change in the budget relating to personal tax was that of the personal tax-free allowance, which is now increased by another £500 to 11,500. This is set to increase to a total of 12,500 by 2020. Now let's move on to business tax. This was what the Chancellor had to say about business tax in his 2017 budget speech.
Britain has the most competitive corporate tax regime in the G7, and we are determined to make Britain the most attractive place to start and grow a business. But to do that, we must ensure that our corporate tax regime does not encourage people across the economy to form companies simply to reduce tax liabilities, pushing the burden of financing our public services onto others.
So that is correct. Compared to other established economies in the world, for example, US, France, Italy, Germany, Japan, Canada, which collectively make up the G7 states, UK does have the lowest corporate or business tax rate. Since 2011, this has been around 20%, but from this April, it is set to be 19% and to go down to a further 17% by 2020. The UK's Treasury has been losing quite a bit of revenue due to taxpayers setting up and operating through their own limited companies. Though technically they would have been employees. I mean, they fit the criteria of employment. For example, they work for one company, they see regular, more or less the same income, and hence should be treated as employees. Most of the loss in this revenue due to the scope available to national insurance contribution working as a limited company. Through a limited company, you could more or less manage how much tax and national insurance you would like to pay. The earnings would basically be split between a basic salary you'll take from your own company and the balance you will take as dividends. And as a taxpayer, you were entitled to an additional £5,000 tax-free allowance on any dividends you took from your own company. This £5,000 tax break on dividends made the limited company structure very attractive for tax purposes for obvious reasons. And unlike being self-employed, where you at least pay Class 4 national insurance contributions, through a limited company, you would avoid paying national insurance altogether. This obviously was costing the Treasury millions each year, as the limited company structure was hugely popular and still is.
HMRC estimates that existing incorporations cost the public finances over £6 billion a year, and the OBR forecasts that at the current rate of increase, an additional annual cost to the Exchequer will occur from those choosing to incorporate of £3.5 billion a year by 2021-22. The gap in total tax and NICs between an employed worker and one who has set up his own company will normally be greater even than the gap with the self-employed. And there are several perfectly legal ways in which that gap can be made bigger still. This is not fair and it's not affordable.
So to close down on the dividend and NI loophole for directors, one-man director companies who were operating independently, the Treasury has announced a reduction in the tax-free allowance that was previously available through dividends from £5,000 to be reduced to £2,000, so a £3,000 reduction in the tax-free allowance for dividends. Obviously, this reduction is mostly targeted at small business owners and directors who were typically making full use of this £5,000 tax-free allowance and the dividends they took from their company. Another area the Treasury wants to focus on is the subjective treatment of capital losses compared to trading losses.
Since 2010, we've secured £140 billion in additional tax revenue by taking robust action to tackle avoidance, evasion and non-compliance. These actions have helped the UK achieve one of the lowest tax gaps in the world. But there is more that we can do. In this budget, we set out further actions to stop businesses from converting capital losses into trading losses.
So to increase their losses and keep tax low, businesses, small companies, one-man director firms have typically more or less used or abused what is a capital loss and what is a trading loss. Trading losses, obviously, they provide immediate tax relief to the accounts and tax returns, while capital losses are, by their very nature, designed to provide relief over a period of time, 2, 3, 4, or 5 years, usually. However, with companies claiming capital losses as trading losses has resulted in the Treasury losing millions each year. So to further clamp down on this avoidance scheme, HMRC will most probably start to scrutinize more carefully the tax returns and accounts companies submit to HM Revenue and Customs to see if the correct treatment is actually being applied relating to capital losses and trading losses. This austerity measure will generate an additional approximately 820 million in revenue for the Treasury. Other taxes such as VAT, national insurance paid by employees and employers is almost the same. It's remained the same throughout the coming tax year. The final topic that I'll be covering is that of business rates. Business rates is a tax that needs to be paid by the occupants of non-domestic or mostly commercial properties. It has been around for 100 years, but was officially made legal in 1990. Is basically another tax collected by HM Treasury to fund mostly local government, like the councils and other local offices. Business rates has somewhat been burdening small businesses, restaurants, shops, all across the UK for quite some time. With rates amounts to increasing each year, while businesses themselves more or less suffering to stay afloat. So several small businesses, lobbyists, and government officials have been lobbying to abolish business rates altogether, saying it is out of date, it's an unfair on local businesses, it's a very predated system, as most retailers are now struggling to stay competitive with digital vendors or online vendors like Amazon, eBay, and so forth. So this is what the Chancellor had to say about business rates in his 2017 budget.
And Mr. Deputy Speaker, there is one further area in which I can announce action to back British businesses. My right honourable friend, the Communities Secretary, and I have listened to the concerns raised by colleagues in this House and by businesses about the effects of the 2017 business rates revaluation. Business rates raises £25 billion a year, all of which by 2020 will be going to fund local government. So we cannot abolish them, as some have suggested. But it is certainly true in the medium term that we have to find a better way of taxing the digital part of the economy, the part that does not use bricks and mortar. But in the meantime, there is scope to reform the revaluation process, making it smoother and more frequent to avoid the dramatic increases that the present system can deliver. We will set out our preferred approach in due course and will and will consult on it before the next revaluation is due. The revaluation itself, Mr. Deputy Speaker, is by law fiscally neutral. And ahead of this revaluation, the government committed to a package of cuts to business rates now worth nearly £9 billion, permanently doubling the rate of small business rate relief to 100% and raising the threshold so that 600,000 small businesses are taken out of paying rates altogether.
So some of you may remember there was a business rates revaluation that took place in September last year, with property values soaring all across London, mostly central London, southeast areas of London like Brixton and Hammersmith and those sort of areas. The government in September 2016 did a whole full revaluation overhaul of the business rate system to kind of more or less reflect the increase in property value of these non-domestic properties for businesses. This now means businesses operating in and around property prices have sharply risen. They will see a corresponding increase in their annual business rates bill. For example, some stores, shops based around central London will see their business rates increase as much as 415% over the coming 2, 3, 4 years. This increase in business rates is based on increasing property values, will most definitely discomfort those businesses already struggling, yet operating in high value areas. For example, independently owned pubs and restaurants.
The revaluation has undoubtedly raised some hard cases, especially for those businesses coming out of small business rates relief. So today, as I promised many of my right honourable friends I would, I address those concerns with 3 measures which apply to the national business rate system for England.
So to mitigate this blow to small businesses that business rates will have, the Treasury laid out these 3 measures.
First, any business coming out of small business rate relief will benefit from an additional cap. No business losing small business rate relief will see their bill increase next year by more than £50 a month. And the subsequent increases will be capped at either the transitional relief cap or £50 a month, whichever is higher.
So businesses operating in high valued areas or high property areas would see a corresponding increase in their rateable value. However, the government has something called the SBRR, which is the Small Business Rates Relief System, in place. This basically provides small businesses a discount on their business rates, provided their property's rateable value is well within the SBRR, or the Small Business Rates Relief threshold. However, now those businesses that have seen their rateable value increase on account of the revaluation in September due to the soaring property values will most probably be pushed out of the small business rates relief bracket and pay business rates at the full rate. To cushion this blow, Treasury is now going to cap the increase in rates to only £50 a month for the 2017-18 tax year. And a further transitional relief cap will also be introduced to further limit the increased business rates payable to small businesses. So either the £50 increase or the transitional relief cap increase, whichever offers small business owners the maximum relief, will be used when calculating their business rates for the coming tax year. This obviously will help some small business owners for the next 2 to 3 years run up to the actual full increase, and will provide somewhat of an adjusting period for small businesses. This is the second measure announced for business rates by the Chancellor.
Second, recognising the valuable role that local pubs play in our communities, I will provide a £1,000 discount on business rates bills in 2017 for all pubs with a rateable value of less than £100,000. That's 90% of all pubs in England.
So, as we all know, pubs, bars, restaurants have a staple space in UK's social economic culture for many, many years. So ever since the last business rates overhaul was announced in September, the pubs and catering industry has been lobbying hard on how unfair the rate system is for them and how the changes and sharp increase in their business rates bill could threaten their survival. To somewhat hear the cries of small pubs and restaurant owners, the Treasury has proposed a £1,000 discount on all business rate bills for the coming 17-18 tax year. This is only for pubs with a rateable value of £100,000 or less, which is mostly 90% of the pubs that actually operate here. Whether this discount will be of much help to small pubs and restaurants, only time will tell. But it does signal that the government is listening to small businesses.
And third, on top of these two measures, I will provide local authorities with a £300 million fund to deliver discretionary relief to target individual hard cases in their local areas. This fund will be allocated to local authorities by a formula, and my right honourable friend, the Communities Secretary, will set out details in due course.
As with pubs and restaurants, this again is a remedial action by the UK Treasury to fix the effects of the new business rate system on small businesses. So a fund of £300 million would be available to small businesses through their local councils to help, basically. How small businesses will have access to this fund, or the criteria, or what be classified as hard hit, and how the fund will be distributed is still a bit unclear, but this is something we'll have to wait and see how this £300 million fund is actually used. Okay, so this wraps up the budget review from my side. I hope you found this review helpful. If you do have any further questions regarding this year's budget, which is in place at the moment, or you would like a more informal decision on how the budget could affect your taxes or business, please drop me an email on info@klarmans.com. Thank you for watching.